If you have long-term bonds or government bonds, generally speaking, now is, I think, the time to liquidate and rebalance into stocks. I mean, look, this is freaking nuts. All right, so look at this. I'm going to show you two charts. This is going to be the 30-year Treasury. All right, so look at this. The 30-year Treasury, this is going to show you the opposite. That is the yield. You see the yield falling off a cliff. The yield on the 30-year Treasury is at 1.215. That's insane. So the yield goes one direction, the price goes the other. So here's the price. It was trading at, this is the beginning of the year, 82 bucks, 84. Now it's at 90, at 101. So if I take my trusty calculator and 101 minus 84 is 17, I always use my calculator, divide that by 84. That's a 20% year-to-date increase, my friends. Look, man. But Josh, you always say bonds don't give you any positive. They don't give. If you hold on to these, you're always going to go back to par. It's what happens with bonds. There's no getting around this. But that doesn't mean what that means is, if you're going to hold the bond and expect to buy another bond, all right, you're not making any money. You're trading A for A. It's literally you're trading this house for that house across the street. That's all there is to it. That house might have, a couple more freaking drywall basements than I got down there or something like that. But basically, you're trading house for house across the street. It doesn't make any sense to do that. But if you're having the opportunity, which is sell a bond in order to buy a stock that's getting hammered, it completely makes sense for sure. In this case, you're getting free money. Take it and reinvest in stocks. So look at that. Now if we go to, let's go to a year. So it's 84 now. Oh, it was 104 to start the year. 52 weeks ago is at 74. Oops, that's my T. Hold on a second. But 52 weeks ago, the 30-year was at 74. Now, what do you say? 101. So we take our trusty calculator. 101 minus 74 divided by 74. So it's up 36.4%. We'll just say 37%. Now, let's look at that in conjunction with, we're going to look at just VFINX, just for the S&P 500 index fund. And we're going to go year to date so far. We started at 300. This is the Vanguard S&P 500. Is that March 3rd? That's March 4th. That's not even as of. So that gives us as of March 4th. That's old. Why does it not give us up to date? Make sure this is up to date. Yeah, this is up to date. March 6th. Okay. Yeah, why is that? That's weird, man. Why is it? Let's go VOO then. I'm not sure why the mutual funds are 2 days back, but we'll go VOO. Let's see if that gives us today. Yeah, that's weird. Okay, so if we go to year-to-date, VOO, start at 298. Now it's down to 273. That's it? That's not bad. All right, 298 to 273. That's not as much as I would have thought. So that we'll say 311 on 2 weeks ago. So 311 minus, what was we at? 278 minus 273 equals 38 minus divided by 311. So that's down 12%. So anyway, so now's the perfect time to lock in some gains for sure. I wonder what let's go to VDI. So what's getting hammered? VDIGX. So the S&P 500 is getting hammered. Let's take a look at the Vanguard. That's not getting hammered. Again, why does it go back? That's weird. The mutual funds are a little bit of a lag there. What would we want to do? What's getting hammered? I was aiming NAESX. That's the Vanguard small cap, and that is as of March 5th. So it's not that bad. All right. Well, anyway, that doesn't seem as bad when you're comparing it to the bond market for sure. Well, let's just do Ginnie Mae. Well, let's just do this bond. Let's just do this right here. Go to year to date. Yeah, same thing. Well, that's not. I mean, that's 4, 8. It's not that big of a deal there. I mean, it's up 6% or something like that. I'm surprised by it. But anyway, if you have long term, what is this? Yeah, Vanguard Total Bond Index. Oh, hold on a sec. Anyway, so if you had, that's not that big of a deal. I would have thought the shorter term bonds haven't done much relative to the long term for sure. And that makes sense because long terms are the yields are just way down. Let's tell you what. Hold on a sec. Let's go to the. I'm gonna go to the Treasury yields. Hold on a sec. I'm at the daily Treasury yield curve rates from the U.S. Department of Treasury, which I love. I'm on this page a lot, as a matter of fact. So let's go to. I want to go to. I'm gonna go to all, and I don't want every day. Can I do yearly? I can't remember. So let's see if we can do go. Just thinking about it. Just thinking about it. Let's go. So we got. You can see is that the 30-year just 4 days ago 1.66, which I thought was crazy. All right, so let's just go back here. We're going to go to 1990. It's 8% in 1990. Let's go to. I mean, we're not. I mean, has it ever been this low? I guess we could go back to 2000. Let's go to 2001, and yeah, 8.4, 8.4, 8. I mean, look at that, man. That's crazy. All right, so let's go to 2001. See what they went down. So remember, 94, the Feds were raising. Let's see what we got in 94. 6.5, 6.5. When did they? Yeah, you can see them start. I mean, what they do is they raise the low end on the short end, but it didn't really affect. It never really, but it still were creeping up. Yeah, 7.5. Actually, let's see what happened in 19. When was the Iraq War? 1990, right? 1991. Let's see if they went up to 9 by chance. Let's see here. So 1990 at 8.66, 8.7, 8.85, 8.9, 9.04. Look at that. Man, look at that. May of 2090. So when I was in, when I was in Ranger School in, was it July of 90 or August of 90, we mustered out there when I was up in the mountains, and they called out some guys from various units, like a couple of SF guys that I was with, and they went because they went to turn around and go get deployed to Iraq, and I think it was in August. So that was when the war was really starting to ramp up. In August, the rates were kind of settling down again, and then we go at 9.17. Look at that. Yeah, August, right there, right around then. I guarantee that's right at the time they started mustering people to send them get ready to hit Iraq. And then in December, I think is when they really started. Yep, 9.05, 9.18, and the oil prices are spiking. Everyone's crapping their pants, nuts. All right, and then look at that. That's crazy. And then all right, so let's go to 2001 when the September 11th happened. I can't imagine that the 30-year got much lower. What, 3? Yeah, 2000. Hey, buddy. So 2011, 1, yeah, it's 5. So the 30-year is still at 5s, 5.5, 5.5, 4. Yeah. All right. So even in 2001, the 30-year is still at 5.5. What's up, big man? You want to come up here? Okay. Come on. Come on. Bob wants to say hello, everybody. Say hello, Pablo. Let's go to 2008 then. Love you, big man. And they were raising rates in '99 too, by the way. Love you, buddy. So 2008, 4.25, 4.4s, down to 4s. I mean, that's the 30-year down to 4s. Look, I mean, that was insane back then. 2.69 in 2008. At the end of 2008, we're down to 2.58, which I never thought we'd ever reach anywhere near that again. So if we go down 2009, there's a method why I'm saying all this, my friends. We go 2009 back up to 3 in March. Back up to 3. Yeah. You can see back up to 4s, back up to 4, high 4s, low 4s, back to 3s, still 4s. All right. And then I think in 2015, I think the rates went back down again quite a bit. So let's just take a gander. 2015. Yeah, 2.5, 2.4, 2.2. Look at that, 2.25. Yeah, 2.25. I mean, yeah. So low mid twos and then back up to threes. Yeah, and then back under 2.9s. Yeah, so low high threes, high twos, low threes. As before Pablo was born. All right, that's interesting. Anyway, so let's look at again. Let's go now to 2020. Hang tight, big man. Hang tight, dog. Hang tight, big guy. Yeah, Pablo, you're my density. Pablo, you're my density. Remember that? You're my density. And then we got 2.23. Oops. 2.18, 2.05. So basically, what 1.25. 1.25 on the 30-year Treasury. I don't know why you wouldn't sell that bond and just take your gains off the table and dump into stocks. Um, I, this is insane. We've never been anywhere near this amount ever. Literally, I'm stunned. In 1982, that same bond was paying 15 and a quarter. I just showed you, and is paying the low nines in August of 2000, August of 1990. It got down to less than about 2.25 a couple times since then, but that's it. Now it's at 1.25. Hey. If you have universal life insurance, you're in a world of hurt, man. I'm telling you right now. I'll do another video on that. All right. Sell your long-term bonds, man. Sell your long-term bonds and reinvest in stocks. I mean, look, if you don't want the risk, by all means, but if you got long-term bonds, now it depends on what you're holding. I mean, if you're holding a long-term bond at, that you bought at 6% or something like that, that's you're gonna you'll make a killing on that. Man, I don't know. I would be taking gains off the table. There's no other way around that. I'd be taking them off the table. And I don't own any long-term bonds, so I'm a hypocrite because I can't do what I can't own, can't sell what I can't own. But man, that's all right. We'll see you.